Welcome back to the channel. I'm AlgoBot, your guide to the mechanics behind automated trading systems. In this session, we're going to unpack an expert advisor for MetaTrader 5 called the Omega Ratio Trend Pullback. This strategy is built around a lesser-known statistical measure called the Omega Ratio, a probability-weighted gauge of gains versus losses, and it pairs that idea with a classic pullback continuation approach. By the end of this video, you'll understand how the strategy reads market conviction, how it waits for a shallow dip inside a trend, and how it manages every trade with volatility-based stops. Let's get started, and remember, this is educational information only. So what exactly does the Omega Ratio Trend Pullback Expert Advisor do? At its heart, this is a trend-following system that specializes in pullback continuation entries. Rather than chasing a market that has already broken out and stretched far from value, it waits patiently for a shallow dip inside an established trend, and then looks for that dip to be immediately reclaimed before committing to a position. The engine that drives the whole approach is the Omega Ratio, a measure introduced by Keating and Shadwick in 2002. In simple terms, the Omega Ratio compares the total area of gains above a threshold to the total area of losses below it. When we set that threshold at 0, it becomes the sum of all positive bar returns divided by the sum of all negative bar returns over a chosen lookback window. Read as a conviction gauge, an omega well above 1 tells us that up moves have dominated the recent tape in aggregate magnitude, while an omega well below 1 tells us the opposite. The strategy only engages when this reading is decisively skewed to one side, because a market that persistently favors one direction is exactly where trend continuation tends to make sense. It reads raw candle data on whatever time frame you backtest, computing returns, 2 moving average baselines, and an average true range measure all by hand, with no external indicator dependencies. Who is this style of approach suited for, from an educational standpoint? It leans toward traders who are studying trend following and pullback concepts on a trending foreign exchange major, a metal, or an index, on time frames from 30 minutes up to 4 hours. As always, this is educational information only, and trading always carries the risk of loss. Let's walk through the exact logic the expert advisor follows, step by step. The strategy acts only once per freshly closed bar, so it never reacts to the noise of a still-forming candle. Before doing anything, it checks that enough closed history exists for its widest lookback. First, it computes the Omega Ratio over the OmegaWindow, which defaults to 30 bars. It walks back through the window, adding up every positive bar-to-bar return into a gains total and every negative return into a losses total, then divides the gains area by the losses area. From the OmegaMargin, which defaults to 0.25, it derives 2 thresholds. A bullish regime requires Omega to be at or above 1 plus the margin, which is 1.25 by default. A bearish regime requires Omega to be at or below 1 divided by that same figure, which is 0.8. Only a decisively skewed reading counts. Second, the strategy confirms trend alignment using 2 simple moving average baselines. The fast baseline defaults to 10 bars and the slow baseline to 45. For a long, the just closed price must sit above the slow baseline, and the fast baseline must sit above the slow baseline. For a short, both conditions are mirrored to the downside. Third comes the pullback and reclaim signal. For a long, the strategy detects a genuine 1-bar countertrend dip, a bar that closed lower than it opened. The very next bar, the just closed resumption candidate, must close bullishly back above that dip bar's high and back above the fast baseline. That reclaim is the entry signal. For a short, the mirror applies, a 1-bar upward pop, immediately rejected by a bearish bar that closes below the pop's low and below the fast baseline. When all 3 conditions agree, the EA sends the order. The stop loss is placed at a distance of the average true range, measured over 14 bars by default, multiplied by the stop multiple of 2. The take profit is set at a reward-to-risk multiple of that stop distance, defaulting to 1.6, so the potential reward is framed as 1.6 times the risk taken. There is also a spread filter that skips entries when the spread is wider than the maximum allowed, and one further exit rule. If the Omega Ratio flips to the opposite side while a trade is open, the thesis that justified the position is gone, so the strategy closes the trade and steps aside. Trading always involves risk. Let's read the core of this expert advisor the way it appears in MetaEditor. At the top are the input parameters, drawn directly from the strategy definition. OmegaWindow sets the lookback for the gain versus loss ratio, and OmegaMargin sets how decisively skewed that ratio must be before a regime counts. Fast MA and slow MA define the two baselines, with the fast baseline acting as the reclaim reference and the slow baseline defining the trend side. ATR period, ATR stop multiple, and reward risk govern the volatility-based stop and the reward-to-risk target. Max spread filters out costly conditions, and lots sets the order size. Now look at the long block. The condition requires a bull regime and an uptrend, then 3 candle checks. The resumption bar must be bullish, with its close above its open. The prior bar must have been a counter-trend dip, closing below its open. And the resumption bar must close back above that dip bar's high and above the fast baseline. When all of that lines up, the code reads the current ask price, places the stop loss at the entry minus the stop multiple times the average true range, computes the take profit as the entry plus the reward risk multiple of that stop distance, and calls trade.buy. The short block is the exact mirror. It needs a bear regime and a downtrend, a bearish resumption bar, a prior counter-trend pop, and a close back below the pop's low and below the fast baseline. It then reads the bid price, sets the stop loss above the entry, computes the take profit below it by the reward risk multiple, and calls trade.sell. Both sides carry a protective stop and a defined target from the moment the order is sent. Now let's bring the whole idea to life on the chart in front of you. On the price panel, you can see the fast baseline and the slower baseline plotted over the candles, and in the panel below sits the Omega ratio, with a green line marking the bull threshold at 1.25, a gray neutral line at 1, and a red line marking the bear threshold at 0.8. Watch how the two work together. Start on the left. The market is grinding steadily higher, one green candle after another, and the fast baseline is holding above the slow baseline. That is our trend condition being satisfied. At the same time, look down at the Omega ratio. It is sitting comfortably above the green bull line, telling us that in aggregate, up moves have dominated the recent tape. The regime and the trend both agree that this is a demand-heavy market. Then we get the setup. One candle pulls back against the trend, closing lower than it opened. This is the shallow dip the strategy is waiting for, not a breakout that has already run, but a brief pause inside strength. The very next candle is the resumption bar. It closes bullishly, pushing back above the high of that dip candle and reclaiming the fast baseline. All three conditions are now in agreement, and the buy entry marker appears right there on the reclaim. Notice the Omega ratio is still firmly in bull territory as this happens. From the entry, the strategy has already defined its risk. The stop loss rests below the recent structure at a distance scaled by the average true range, and the take profit sits above at 1.6 times that risk. Now follow the candles higher. Price extends upward, the fast baseline keeps rising, and after a couple of strong candles the market reaches the take profit target. The take profit marker prints, and the long trade is complete, closed at its planned objective. Now watch the character of the market change. After that push, the candles begin to roll over. The fast baseline turns down and crosses below the slow baseline, flipping our trend condition to the downside. Down in the subpanel, the Omega ratio is falling too, sliding through the neutral line and pressing down toward the red bear threshold at 0.8. Losses are now dominating the recent tape in aggregate, and a bearish regime is forming. Then the short setup appears. One candle pops upward against the new downtrend, closing higher than it opened, a brief counter-trend bounce. The next candle is the bearish resumption bar. It closes back below the low of that pop candle and below the fast baseline. With the Omega ratio now sitting under the red bear line, the regime, the trend, and the reclaim all agree to the downside, and the sell entry marker appears. Just as before, risk is defined immediately. The stop loss is placed above the entry at the average true range distance, and the take profit sits below at the same reward-to-risk multiple of 1.6. Follow the candles down. Price slides lower. The baselines continue to point down, and the market reaches the take profit target below. The second take profit marker prints, and the short trade closes at its objective. Step back and notice the rhythm of the whole sequence. In both trades, the strategy never chased the first thrust. It insisted on three separate pieces of evidence lining up: a decisively skewed Omega ratio for conviction, two baselines aligned for trend direction, and a single bar dip or pop that was immediately reclaimed for timing. That is the core discipline of this approach, entering on the reclaim of a shallow pullback rather than the extension. And every single trade carried a predefined stop and target from the outset. Of course, not every setup reaches its target in real markets, and losses are a normal part of any strategy. This walkthrough is purely illustrative and for education. That brings us to the end of our breakdown of the Omega Ratio Trend Pullback Expert Advisor for MetaTrader 5. We covered how the Omega Ratio measures the balance of gains against losses to gauge conviction, how two moving average baselines confirm the trend, and how the strategy waits for a shallow pullback to be reclaimed before entering, always with a volatility-based stop and a defined reward-to-risk target. Remember, everything in this video is educational information only, and it is not financial advice, a recommendation, or a solicitation to trade. If you found this analysis helpful, please consider giving it a like, leaving a comment with the strategy you'd like us to examine next, and subscribing for more MetaTrader 5 strategy breakdowns. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.